Great. Thank you, everyone, for joining our first webinar. This is the first in a series called Feed Your Mind. This series is an activity of the Regional Age-Friendly Network. We're very thankful to have you with us today. We will be having these webinars on the first Friday of every month at noon, so please stay tuned. Next month, Friday, March 7th at noon, we'll have MAG's IT Manager, Audrey Skidmore, talking about how to enhance your experience going online and going to different websites, including our very own connect60plus.com. Very excited to today to announce our webinar with Dan Morris. He'll be talking about the truths and myths about reverse mortgages. This is an important element in helping people to age in place and to be able to stay in their homes long term. The Regional Age-Friendly Network in this webinar series is supported by Virginia G. Piper Charitable Trust and by the Pfizer Foundation and Grantmakers in Aging as part of Community Agenda, a national pilot project. Dan Morris has an MBA, and he has been the Vice President and Licensed Mortgage Professional of Cherry Creek Mortgage Company. He joins us today. Please help me welcome Dan Morris. Thank you.
All right, thank you, Amy, and welcome everyone. I'm really excited to be here today and to be using this wonderful technology to be able to communicate with you, and excited about our topic as well, the truths and myths about reverse mortgages. So today I'm going to walk you through some of the basics and some of the things that you need to know about it and give you some of the inside scoop from a loan officer perspective to help you look at this product and make a wise decision. As Amy said, you know, I've been 25 years in the financial services industry, and at first when I looked at this product, I was skeptical. You know, like many of you, you've seen the commercials, you've heard about it and heard some of the stories, and really I wanted to look into this product and find out all the ins and outs about it and see, you know, what is it that is good about the product and what are the things that we should look out for. So, you know, in that skepticism and in that looking at this, I mean, I've done small groups with Crown Financial, Dave Ramsey, so I'm very what you'd call fiscally conservative. And so again, looking at this product and understanding all the ins and outs, what I've found is it's not as bad as everyone or as many people say that it is, and it's not as good as some of the people will tell you that it is either. So if you know the ins and outs, then you can make an informed decision. And I'm going to use this to advance our slide. Let's see. Bear with me here. We'll get this technology going. There we go. My job today is not to sell you on doing this loan. I truly just want to give you the information that you can have to make an informed decision and learn the facts and learn what some of the myths are. Often the times when I'm speaking in front of a live group, I will have a true or false test that I give right off the bat and ask them what they know about it, because many times I get people sitting back, you can see my arms are all crossed and waiting to hear about this product, and they already have their minds made up and they're pretty closed about it. But once we kind of talk about some of those issues, just going through that little exercise opens up the knowledge and opens up their thoughts about understanding this product. So let's go ahead and let's figure out what this thing is. Okay, so the basics. The home equity conversion mortgage, or this is commonly referred to as a HECM. That's the initials, the acronym there, obviously. And they are non-recourse loans that allow homeowners 62 years of age and older to convert home equity into tax-free cash. And you'll see the little asterisk. I'm not a financial advisor, so you need to consult yours before you look into this product to see how it affects you. But for the most cases here, just some of the basics, you have minimal income requirements. Really, in that situation, really what we're looking for is, can you pay the property taxes and the insurance? Also, can you maintain the property along with all of the bills that you have on your credit report? So we're not necessarily looking for a credit score per se. As you can see, we have minimal credit qualifications. We're not looking for a credit score. What we're looking for there is, what are the other bills that you have? What is the income that you have? Can you afford the taxes and the insurance and your bills the way that you have it? So that's really the only requirement there. The other thing in terms of credit qualifications is that you cannot have any federal tax liens or owe any federal debt. So those are things that would definitely make this an undoable loan. You'd have to take care of those issues before you could do this. However, you could be one day out of bankruptcy with this loan as well, because again, we're not looking at credit score, we're looking at the ability to repay. Obviously, the bankruptcy would clear out that ability to repay of your debts, and so you could use this as an option. Again, there's no monthly mortgage payments that are required with this loan, which is why it's attractive to so many people. But you are required, like we said, to keep current on property taxes, the insurance, if you have HOA or condo fees, also the upkeep of the property. Now, someone's not going to come and drive by and ask you, do you have weeds in your yard and you need to clear those out, or we're going to foreclose on you. That's not what we're looking for. They're truly looking for issues that would be safety issues. If your roof is coming in, if your windows are all broken out, those are the types of things that means the upkeep of your home, just making sure that it's in repair. You also, this is a little known fact, everyone seems to think that I'm losing the ability to own my home. I don't truly own it. Well, let's talk about a traditional mortgage for just a minute. On a traditional mortgage, do you truly own the home? Well, the bank would probably look at that and say, well, we own the home until you pay us off. And that's the same with this loan. You actually retain the title to the home just as you would a traditional loan. And that's a fact that most people were surprised about. They missed that in my true or false quiz. Hey, also, I want to just point out that if any of this information as I'm going through, just make sure that you go ahead and you type in a question. I'll keep my eye on that, and we'll make sure that we answer your questions as we go. Again, the proceeds that you receive from this note are tax-free. And when we're talking about tax-free, some folks are concerned about the ability that this loan could affect Social Security benefits or even Medicaid benefits that you have. And in terms of Social Security benefits and just generally speaking Medicaid benefits, this will not have an effect. But again, the disclaimer, we want you to consult your tax advisor to make sure that this does not impact your situation. All right, so let's take a look here at our next slide. So the eligibility. Everyone on title must be at least 62 years of age. Now, sometimes when you've heard about some of the negative things that have taken place with this product, it has been because one spouse has been younger than the other spouse. Therefore, they didn't qualify for the loan. They signed a quitclaim deed when they initially did the loan to take them off of the note. The older spouse was the only one of record. And sometimes, I'm not saying this happened all the time, but sometimes the loan officer might say, well, you'll be put on your 62nd birthday. I've heard that before, or I just didn't know, those types of things. But truly, when you sign a quitclaim deed off of your house, you no longer have any rights in terms of ownership to that house. It's a very serious step, and one I would not take lightly. And frankly, even when you could do that, our company shied away from that significantly, and that's not something that I would want to do, because again, it all looks good at the time, but if something were to happen, then it's the mortgage company's fault or the loan officer's fault, and frankly, we just didn't want to take that risk and put people into that type of a situation, so we stayed away from that. But now you have to be truly careful about that, because again, you're going through some counseling, which we'll talk about that next. You have to complete counseling from a HUD-approved counseling agency. Now, these agencies are independent agencies. They're not owned by the mortgage companies. In fact, HUD is the one that approves them and certifies their services. So what happens in those situations is that you would take your information, you would either make a call or a visit. You can visit them in person, or you can call in, and in the case of Cherry Creek, at least, we will send them a link to your numbers, and most mortgage companies will at least give them some of the information that you have some way, but we want them to be able to see all of the numbers that we gave you, and so that they can truly answer questions independently and make sure that what I'm telling you or others are telling you are correct. And they want to make sure that you have the understanding of what it is that you're getting into. So it's very careful, the last thing that any mortgage company or anyone truly wants is to be on the 6 o'clock news saying that we had to kick someone to the curb who's elderly, and we're in a situation there where we have some bad publicity. So we think it's a good thing from the lending perspective that this extra layer of protection is there, and I think it does protect many seniors, maybe hearing it a second time or even a third time, or making sure that all that's being said is correct, is going to help out. So moving on here, some of the other eligibility: you must occupy the home as your primary residence. And what that is defined by, because in Arizona we have many snowbirds, and people like to live back east or up north. Not now, I hope. It's very cold, and don't want that weather. We've been very blessed here to have great weather, but so they're snowbirds. And so 6 months out of the year they have to reside here in their home in order for it to be considered their primary residence. Now, you must own the home as well, so it can't be something to where you have another lien on the property, because the HECM mortgage or the reverse mortgage must be the first mortgage, but it can be used to pay off existing liens. If you have a lien on it, we can use this loan to actually pay off an existing loan that you have, which is another misconception that many people have, is I have to be debt-free in order to get into this loan. On my mortgage, I have to have my mortgage paid off, and that's actually not the case. You do not have to have your mortgage paid off. It just has to be, the lien amount has to be less than what you owe, or you have to come to the table with some closing funds in order to pay that off. So that's that aspect of it. So let's move on now. Let's talk about some of the properties that we're dealing with here. Again, the eligible properties from a primary residence only. There's no second homes permitted. Now, the borrowers can be out of the property no more than 12 months, 12 consecutive months. So sometimes there's an illness that takes place, maybe a hospital stay. People are concerned about, well, will they come and take my home from me? And trust me, this is not on any bank's agenda or any investor's agenda to want to come and take the home away. That's not what people want to do. However, we have to be in a situation where we know that the asset that the bank and the investor has on their books is being cared for, and that the value of that investment is still holding its value. And obviously, if you're not living in it for a prolonged period, we know the stories that can take place with people coming in and stealing things and that type of thing. So, so they are concerned about that. And some of the questions that I get sometimes is, how will they know whether or not I live there or not? Well, sometimes they're going to pick up the phone and they're going to call you, and they're just going to ask you, are you still residing at the address that you're at? And so that could happen every 6 months. I know of some situations where some borrowers have had that phone call just to check in and finding out if everything's okay. So that's one of the things. Also, when we take an application, there's emergency numbers as well. So if something were to happen, that we have some other contacts that we can follow up with to make sure that everything's going okay there. So again, back to some of these eligible property statuses: multifamily, 2 to 4 units. You could have one of the units. As long as you occupy one of the units, you can lease out the rest of them, but you have to occupy one of the units in that situation. FHA approved condominiums, those are also eligible. So a smaller home that's in an FHA approved condominium development can also be used with this loan. All properties must meet minimal FHA appraisal requirements. And what that means is FHA and conventional loans are just a little bit different in that FHA is looking for safety. They're looking for structural, that it's stability, structure stability. And those are the types of things that in an FHA appraisal, if you had, say, someone took a ceiling fan and you maybe had the wires capped off, that would have to be not replaced necessarily with a ceiling fan, but at least completely capped off with with something to where people couldn't get to that exposed wiring right there in the room like that. Other things, I wouldn't say cracked windows per se, but if a window's completely broken out, those might be an issue. If they see something from a foundational perspective that looks like it could be on a shaky foundation, now that would be a concern and would be brought out in the appraisal. But generally speaking, FHA guidelines have really lessened very much in terms of the rigidity of the requirements, because it used to be that even some of the cosmetic things that took place, they would they would say that this has to be fixed and this paint that's chipping needs to be fixed. Well, that's really not a safety or a structural issue for the most part. So those things are not as big of a concern. There are times where if you do have an appraisal that says that there are some repairs to be made, you can still go through with the loan, and as long as those repairs are made within 6 months of the loan closing. So that's a unique feature here, and that requires some of the follow-up and another inspection by that appraiser, that once your property is fixed and repaired, then the appraiser will come back out and they'll just make sure that all of that information or all of those repairs were completed and that the house is safe and sound there. Okay, so the next one here, let's talk about some of the products that are available. And this is interesting because as I go through these different products, I want you to be aware that at least on the adjustable side, which I'm going to talk about, that these products can be changed even in the middle of the term. Now we'll kind of discuss that when I get to that point, but that's something to kind of keep in mind, that you're not locked in to any specific term, except if you're going to go fixed, you are locked in on a fixed rate. You're locked in that situation. But if you go with the adjustable and you take out monthly payments and that type of thing, you are not locked in to keep accepting those if your situation changes or you want to take the loan in a different way. So we'll talk about that in just a moment. But first of all, the refinance is available as a reverse mortgage or HECM fixed rate or an adjustable rate option. And the adjustable rate is based on the LIBOR index, much like prime. It's the London interbanking rate, and I'm drawing a blank right now on the O, but it's just an index much like prime that just indicates the way that the financial markets are moving, and there's typically a margin that is attached to the LIBOR rate that will affect the overall rate that you pay in terms of the loan amount. So obviously a fixed rate, that's going to stay fixed for the life of the loan. There are multiple margins to choose from, and this is something that that you really need to understand your options here, because and we're going to go over loan costs here in just a moment, but I want to kind of talk about this because what happens in the HECM adjustable rate option is that there are times where you can maybe save some fees that are involved in this loan, and saving those fees, but your interest rate may go up a little bit. So the lender is going to get their money one way or the other. It's just a matter of, is it better for you to have a little higher rate and maybe not necessarily have the fees up front? Now, most of the fees, you know, again, if you have equity in this, all of your financing costs of this loan will go into the loan, and there's nothing out of your pocket. So you need to understand that aspect of it. Nothing will come out of your pocket in that situation unless you don't owe enough to cover the costs. Then you might need to come to closing with some money to make sure that that's taken care of. However, in this situation with the multiple margins and the costs and things, there may be a situation where, you know, you're real close, you don't want to come out with any cash, so you're willing to take a higher rate. But as long as you understand that it's coming from somewhere, then you can make that choice yourself. The initial interest rate will determine on the available principal limit on either option. So we'll talk about that as we move along here as well. So again, the HECM for purchase is also another product that I want to kind of show you, and this will give you a good idea about not only purchase business but also refinance, just to give you an idea about, you know, what would I qualify for and what kind of equity do I have to have. Yeah, and I'm not sure where that slide went, so we will we'll come back to that one when I find that here. So let's move on to the proceed options. Now this, again, the options that I'm going to talk about now with the tenure, the modified tenure, the term, the modified term, all of these are options that you have, and they're only available with the adjustable rate option. Now, a lot of the times people are very concerned about their rate adjusting, and right now we're at traditionally just incredibly low rates. Are they going to go up? Yes, they are going to go up. So, and I tell all my clients that I talk to about that, yes, they will go up. And the mindset that I suggest to people that they have in considering this is, if you're concerned about the equity and you really need to have that equity, this may not be the loan for you. If you're concerned about passing the home on to your heirs, and I always use the example of, say, the Kennedy compound. If that's a house that they want in their family, and it's something that they want to pass on, then this obviously would not be the right loan for that individual that wants to pass that on. However, the option here with the adjustable rate is not a bad option if you consider that you're not going to have the mortgage payment, so that's going to save you some money there. And the idea would be, and this isn't necessarily the case, but the thought process that I would have is, my equity is going to be used up by doing this loan, that I'm not going to be banking on anything being there at the end when I do this loan. If you go at it from that mindset and you're comfortable with that decision, and that's worth not having a mortgage payment, then by all means this would be something that would work for you. However, if there's a concern about that, and in fact many times I talk to people, insurance carriers with long-term care insurance, if you look at your assets that you have, you want to make sure that you have a plan that if something were to happen where you needed long-term care, that you would be able to take care of that with the assets that you have, and that you're not going to rely on this home to do that. So I just want to make sure that that's understood with this product, because that's definitely something to consider. Maybe even taking out a long-term care policy might be advantageous to you, to make sure that you take care of that issue if there are no other assets that are there to handle that. All right, so let's come back to some of these proceed options that you can take. We've got the tenure. Now the tenure means that you would get equal payments over the life of the loan. So there's some situations where, say, there's $1,000 available. So not only would you not have a mortgage payment, or even if your mortgage were already paid off, you could get supplemental income that would be $1,000. Again, we're looking at tax-free scenario, because this is just depleting the asset that you have. It's not new income that's coming in. It's money that you've already paid and had taxes on. So this money would be coming in once a month, and you could have it for perpetuity. Now, some people are nervous about this because what happened back in the housing crash that we recently experienced, and let's say that that house, all of a sudden, that the value of that house is much lower than what the loan amount is on the property. Well, that's why this is not a bad thing here from a tenure perspective, because we've already done the calculations in terms of the anticipated equity increase and so forth. The tenure payment does not stop. Even if you are upside down in the house, your tenure payments are going to continue to come in. You're going to continue to receive that income as long as you are in that house, and as long as you're keeping up with your agreement of taking care of the property taxes and the insurance, then you won't have any issue there. The modified tenure is a little different. It combines a line of credit with monthly payments for as long as one of the borrowers remains in the home. So again, if there's a married couple, two people that are on the loan, and one passes away, that does not change anything within the loan itself. It does not become doable. The other party is not asked to move. Only if they sign that quitclaim deed, like we talked about before, then they're asked that, they're living there, then they would have to leave. Now, one of the things that has come up in the past is that sometimes we have a parent and we have a child that's living with the parent at the time, or maybe a grandparent that's living and taking care of grandkids and that type of thing. And even if they're of legal age, they would have options at that point. They can either pay off the loan and refinance the house at that point. They can walk away from it and not be obligated whatsoever from any of the debt, so you need to be aware of that. But they would be asked to move within, it's not going to be tomorrow that they're going to get the call and say, hey, you have to leave right now. So it's typically within a 6-month to even a year time frame that the person that is not on the mortgage would be asked to leave the property. So you just need to be aware of that. Obviously, something that happens, something tragic that takes care of of the homeowner. We don't want to be in a situation where we're adding that stress to the situation. So we want to make sure that the estate can get taken care of and those types of things. So it's going to take some time, but generally 6 months to a year is the time frame that you have at that situation. Now the modified tenure, again, this could be something where you have a line of credit with a monthly payment. So you could take a little less in terms of monthly payment and know that you've got a certain amount with a line of credit that you can access for maybe a one-time need or a couple-time need. It is a line of credit, and it is something that is continuous. So you can have both of those with a modified tenure. A term proceed option provides the largest monthly payment, but it's only for a given amount of time. So let's say on a term that you're in a situation where you're waiting for your full benefit of Social Security to kick in. You don't want to quite claim all of your Social Security at this point. You want to wait until you get the maximum amount on the Social Security, and this is where a term option might kick in, to where you're going to take it for a certain amount of time. The amount that you need, you're not locked into any particular amount, but there's limits obviously as to what that might be. But you can take it, say, for 5 years, for 10 years, whatever that time period is, and then it will stop coming in automatically after that time period. So that's something to consider. The modified term combines the line of credit with monthly payments for a fixed number of months. So again, you could still have the line of credit. You can have the term, which, say you wanted it for 5 years to help you bridge that gap with Social Security, and then that term amount would be going away and you'd be left with the line of credit, and you'd still have that available, but the term payments would stop at that point. So, and I know that's a lot of information. So again, if there are questions, please feel free to type those in, and I'll be happy to answer those for you. So again, if you decided, hey, I'd just like to have this loan and I want to have just a line of credit, well, in that situation, you would be there where you could have the line of credit, and you could pull it out up until that time where the line of credit was exhausted. And what's interesting about this line of credit, which is a little different than what you get most of the time in a traditional home equity line of credit, and that's a question I'm asked all the time, is what's the difference between this line of credit and if I were just to get a regular line of credit at the bank? Well, one of those differences is that the home equity line of credit that you're going to get from the bank will give you the money. However, you have to continue to make payments on those. And that line can be frozen at times as well, such as when we had the recent mortgage crisis that took place when the properties were devalued. Many people had their home equity line of credit actually frozen, where they could not access it, yet they still had to make the payments, but all the equity was used up. The bank had done an evaluation on their own, and so they froze the line many times without even sending the consumer a letter letting them know that that line was frozen. That cannot happen with a reverse mortgage or a HECM line of credit. That cannot happen. In fact, the interesting thing about this line of credit is that it actually has a growth rate attached to it. The mortgage company is simply making a bet in this situation. It's much like a life insurance policy. They're looking at actuarial lifetime guesses as to how long people are going to live. And in this situation, they're saying, all right, we're going to make a bet that this is the average age that people are going to live to. And so we're going to say that it's going to be about 4% appreciation for the house, and we're going to have we're going to add actually equity to the line of credit if you're not using it, and it's actually going to grow. So in that case, you'd have the credit line growth rate is based on the current note rate and the loan product plus the monthly mortgage insurance premium. So typically that monthly mortgage insurance premium is about 1.25%. That's annualized to make a monthly payment. And then you have your interest rate. So you take the interest rate and the mortgage insurance premium, which we had already kind of guessed that you were going to be using it throughout the term, If you're not using it, then your line of credit actually grows because those reserves are available. And that's a concept that is a little interesting in this situation. And frankly, out of all the aspects of the reverse mortgage, if I were to advise people, if you were fine financially and you could withstand, the financial events that were taking place in your life, and you just wanted something that were there to help you, then the line of credit is actually the best option, because now you can you pay the closing costs within the line of credit, and that stays there, but you have that access to those funds at any time, and it's actually growing during the life cycle of the loan. Another option that you can do is the lump sum cash. Now, the lump sum cash is available, and all the funds are actually dispersed at closing. So that's something that most of these loans actually, the reason that we had such a problem with these loans in terms of delinquency and that type of thing, is that many people would take the lump sum of cash out, and then they would not have the ability, they'd use the money. And I've heard of people even taking vacations, and some people not necessarily just frittering it away, but using those funds up, and suddenly they can't pay their taxes and their insurance. And so people would, the investors, if the taxes and the insurance aren't being taken care of, then that asset becomes something that is an issue, and it's not as secure of a loan, because if the house burned down and it's not covered, now we've got an issue there. So the bank would come in that situation and take the home, but it's something that they've changed the rules here back in October of 2013 to where if you take a lump sum cash disbursement, if that amount is 60% above and beyond or 60% above the loan amount that you would have there, then you're going to be in a situation, 60% of the actual available amount that you could pull out. If you're going to be over 60%, then the upfront mortgage insurance premium is actually higher, and it's considerably higher. And I want to kind of go through here and talk about some of these costs. But again, the reminder on the bottom, you can also change payment options during the loan with the LIBOR adjustable rate product. You cannot change it with the fixed product unless you refinance the loan altogether. And that's not something that I recommend, because the costs then to refinance this loan add up, and it eats into the equity, and it's typically not as good, especially with the interest rates the way that they are right now. So it's very important that you really understand your options going into this decision. Okay, we're going to talk a little bit about loan amounts. Homeowners are surprised to learn that they cannot access the entire value of their home. My home is worth $300,000. Why can't I pull out the entire $300,000? So instead, the way that it's calculated, it's determined by a unique combination of factors. So some of the things that we're looking at are the value of your home, and that's the lesser of the appraised value or FHA lending limit, which is currently $625,500, and that's higher for the HECM loan. You can go up to that amount there. The age of the youngest borrower, current interest rates, the program you select, the fixed or the adjustable rate, all of those things factor in to how it's calculated as to how much your loan amount is. And so I have a computer program that I use here that takes all these algorithms into effect, and I'm able to give a quote for someone that is that's looking to figure out this product. Okay, here we are. This is actually the purchasing part, and this also gives you an idea about what loan amounts are available for different purchase prices or appraised value. This is the same type of thing. So with the purchase price in this situation, if we let's just take an example of a $300,000 purchase price, and let's say that the borrower is 70 years old. So we're looking at this one right here at $171,000 is what the estimated loan amount would be. This is a little different than what you'd have to come to the table. This is the way we have to disclose this. So what you have to do in this is a little math and subtract the $300,000 from the $171,000. So in this situation, a 70-year-old borrower can come in and put down $129,000 and have no mortgage payment for the rest of the time that they're there, according to the terms of the contract. So that can become very attractive to them, because if they're keeping that extra $171,000 working with them with a financial planner or that type of thing, that can help offset some of those long-term costs as well that they'd come into. But this table kind of explains how much is available, and you can see the older the borrower is, the less money that they have to bring to the table in these situations. So in the same example, an 80-year-old, you're looking at $115,500 that they'd have to come in with versus what the 70-year-old would come in with. So that's just a little idea there. So again, if you had a loan in this scenario, let's say your house was $300,000, you're 70 years old, and you have a loan that's $150,000. This 171 would pay that off, and you'd have $21,000 left over that you could either keep in a line of credit, you could pull the proceeds out. Those are things that, just to give you some round numbers. Now, we'd have to calculate all of this out according to your exact age and everything, but this just gives you a general idea about what this looks like. Okay, this is a fun topic because this is what some folks look at in terms of what does this loan cost and what are the fees that are associated with this loan. And a lot of folks would say that these costs are very expensive. And I think you've got to look at the whole picture. You're actually paying a fee to not have a mortgage payment, and there's some value to that. And when we compare it to, say, a traditional loan, let's really take a look at what these examples are. I want to come back to the FHA mortgage insurance premium. Much like a traditional loan, you have to have FHA mortgage insurance. And that's a concept that some people struggle with because they say, well, gosh, I have all this equity. Typically on a traditional loan, if I have 20% down, I don't have mortgage insurance that I have to deal with. And so this is a little different because obviously at some point you could be over that 80% loan to value ratio, and therefore there is mortgage insurance. Now, the mortgage insurance protects both the investor, which it's primarily there for. I'll just say that up front. It's primarily there for the investor, but it also does protect the consumer in that, let's say that a mortgage company that you did this with went bankrupt. The mortgage insurance premium, HUD would actually have another note that's on here, and they would honor the terms that were originally agreed upon. So that insurance protects you from that perspective. Let's say that you're getting that $1,000 a month with a 10-year payment, and now you hear your mortgage company goes bankrupt. That does not impact this note at all. You will continue getting that $1,000 because it is an insured loan. But it also, again, on the flip side of that, like I said, the investor and the mortgage company, they're making a bet. And if we had something terrible take place again in the housing market where the values dropped considerably, this mortgage insurance protects the lender, and they would get some of their investment back in that situation and not take the big losses that would be there. So that's something that has to be paid, and we're going to talk about that in just a moment. With this, there is an origination fee. The origination fee is typically 2%, and that's typically across the board with most of the lenders. That's just a fee that's in there because as you look down here on the bottom here, it says lenders' fees such as processing, underwriting, and funding are not permitted, and those are typically charged on traditional mortgages. So one of the ways that, since those can't be charged, one of the ways that lending companies get around that is that they put it into an origination fee. You have standard third-party fees that you do in a traditional mortgage transaction, such as the appraisal that's typically collected at application but can be refunded back at closing. You have a credit report, a flood certification, title, escrow, settlement fees, those types of things, and other miscellaneous fees that you may have in a given market. But those are the standard that you do in any mortgage. So the difference with this one, and it's not a difference in all mortgages, but the differences would be the mortgage insurance premium. There's some traditional mortgages that also have that, but in this case, you would have that as well as the origination fee. And sometimes you have an origination fee with traditional mortgages, but that's not a common occurrence, at least in this market. Some of the things that I wanted to kind of talk a little bit about with this mortgage insurance premium, excuse me, let me take a little sip here. If the transaction required over 60% of a disbursement then the mortgage insurance rate goes up considerably. And this is something that you really need to be aware of with this loan. The mortgage insurance rate would be 2.5% the upfront mortgage fee. And again, nothing would come out of your pocket necessarily in this situation. However, if in fact you're over 60%, that's going to be added in there as a cost, 2.5% of the actual loan amount. So you have to be aware of that. And that's if you take over 60% of the available funds in a disbursement initially. Now, they put in some provisions. This is a change that just took place because what they found was that most of these delinquencies and most of the foreclosures that were taking place were because of that lump sum that we were dealing with before. People were taking all of that out, so those became riskier loans. And truly, the changes took place. Some people were a little upset about them because they said, gosh, now I don't get as much money. I'm charged more in terms of the fees and that. But it was one of those decisions that, frankly, the government had to make in terms of either keeping this available for seniors, which they felt like they needed to, or they would disband the program altogether and not have this as an option. And in my opinion, that wouldn't have been good. Even if this product isn't right for everybody, it's nice to have options. We know that all of the financial craziness that's gone on here over the last 5-6 years has really changed the way that people have looked at their finances. And even though this product has been around since 1982, it's one of those things that the different financial times require different financial solutions. So again, this is one of those items that you want to look at, but be aware that that if you take the 60%, it's 2.5%. If you're taking less than the 60% at disbursement, then that upfront mortgage insurance premium is only 0.5%. And that's a big difference when it comes to the fees in this loan. So for example, let's just take a $100,000 loan amount. So you're paying $2,500 if you take 60%, above 60% of the allowable disbursed funds, or you're paying only $500 for that upfront mortgage insurance if you are taking less than the 60%. So that's an example there that you can kind of understand. Again, if the appreciation changes positively over time, this is something that you could get rid of, but don't count on that. We are using 4% appreciation as an assumption right now, but you just, with all of the things that have happened, I don't think there's anything certain anymore financially to count on. So just be aware that takes place. All of these changes that were done, like I said, they were done to increase the reserve amount, and the likelihood of having equity at the end of this increased because they're leaving more reserve in there to have at the end of the loan to make sure that those losses are being taken care of. Well, most of those losses took place in the climate that we were in. So with the positive appreciation that we've been seeing now, those losses aren't quite as prevalent, and the risk of those losses isn't quite as prevalent right now as they were, but we all know that can change. Okay. Let's move on to the next one here. Let's talk about these consumer safeguards. Again, the third-party counseling is set up to make sure that it's with a HUD-approved HECM counselor. These loans are open-ended terms. So, people say, well, gosh, what happens if I live over 100? Am I going to be kicked out of this if I lose the equity in the house at some point? And the answer to that is absolutely not. This is an open-ended term all the way to the 150th birthday of the youngest borrower, and to my knowledge, we haven't had anyone reach 150 yet. There's interest rate caps, and that's something to be aware of, that the interest rate caps on these loans, especially when we're dealing with the adjustable rate, you have to be aware of that. There are caps. It's a 10% cap. Now, again, these rates today are very low. So today, for example, if you were looking at, say, just a round number, if you're about a 2.5% rate on one of those adjustable type loans, then you'd be capped at 12.5% if our interest rates were to go up. So you need to be aware that is something that is more than likely going to happen in terms of raising rates. Not sure how high they're going to get, but you have to be prepared for that, and that's where they would go up to that 12.5%. They'd be capped. There are also origination fee caps that are in place that are great to protect the borrowers. So on a $600,000 house, the 2% is going to be applied. I believe that they're capped at $6,000 if I'm not mistaken, but I'd have to double check that part. There's no prepayment penalty on these loans. If you decided, or one of your, say a financial counselor or someone looked at this and said, hey, you should get out of this loan, there are no prepayment penalties whatsoever. There's a 3-day right of rescission when you do this, except for the purchase deal. We do not have a 3-day right of rescission there. And what that means is that if you refinance the loan, much like you do in a traditional loan, you have the right to look over all the paperwork after you sign, and you have 3 days to cancel that agreement without moving forward on it. So that's a protection that you have on this loan as well, to just truly make sure that this is what you want to do. It's an FHA insured loan. It's a non-recourse feature. Non-recourse means that the investor cannot come back at you if the value of the home is less than what you owe. Say there's a deficiency of $5,000 or $10,000. It doesn't matter what the deficiency is, you would never be asked, or your heirs would never be asked, to pay back that money to the investor. So you can walk away from it if you want to. Okay, next here we're looking at the borrower obligations. So again, here you have to occupy the property as your primary residence. You have to maintain the property in its current condition. If repairs are required, you must complete them within 6 months and maintain thereafter. That's something that just has to be done. And you have to continue to pay all property taxes, hazard insurance premiums, condo fees, HOA dues. All of those things have to be paid. And again, the reason that these defaulted and had a high default rate was because people were not keeping up with the taxes and the insurance. So that's something to make sure that in the plan that you can afford those. The loan repayment, the HECM loan does not have to be repaid until the last surviving borrower permanently vacates the property. Okay, so this is also known as the maturity event, and you may partially or fully repay the loan balance at any time without penalty if you choose. It's not something that you have to. But upon a maturity event, the estate typically sells the property to satisfy the current balance. That's an option that the estate would have. There's a non-recourse limit, which equals the amount repaid as lesser of the loan balance or sales price of the property, less realtor fees and seller closing costs. So keep in mind when you're looking at this, you're looking at some of the fees they're going to be associated with the sale of a home. And a rule of thumb there is about 8% is what you're looking at in terms of what the seller pays to sell the house. So at the end of the day, you kind of take a look at what the balance is, take a look at what the house would appraise for and what it might sell for. And if you subtract out that 8% or so of closing costs, then if you have any money left over, then it's a good idea for you to sell the house. If not, then you may just say, let the investor take it back, and I don't have to deal with it, and I don't have to worry about it. So those are the options that the heirs would have at a maturity event. So here's some, again, I just want to make sure that this is very clear, what would determine a maturity event or a default. Failure to pay property taxes. Even if I say that 5 times, there's people out there that still miss that and aren't clear on that. Failure to maintain hazard insurance policy. Failure to maintain the property. You have to make the repairs required to keep it in good condition. Renting out the property while maintaining property. This is not something that you can turn into a lease situation. It has to be a property that you are going to be in as your primary residence. Again, permanently moving out of the property, you'd have to notify the lender that you're permanently moving, and then you can figure out what your options are at that time and make that work. If there's a sale or a title conveyance, those are things that you have to make sure that you're aware of as well. All right, so 5 simple steps. This is with most lenders that you're going to deal with. It's not a big arduous process, but there are some steps that you go through that are a little unique to the reverse mortgage versus what it would look like for a traditional sale. In this case, you have to be educated, make sure that you read all the information that you get, make sure that you're making a wise decision and that this is going to work for you. Secondly, you want to meet with the loan consultant just to determine the appropriate product and get some figures and get some numbers on what your different options are. What's interesting about that, though, is that you cannot truly make application until you've had the opportunity to meet with that HUD certified counselor. And so your next step would be meeting with that counselor, again, either in person or by phone, and they will send a signed certificate that says that you've gone through that counseling. We kind of joke about it, calling it the golden ticket. This is something that you've got to get in order to make application with this loan, and you can't move forward with it until you have that. Then we go through and we take care of the application aspect of this. Once your loan is approved, you'll then attend the loan settlement and the closing, where you sign your documents and you close on the loan. So those are some of the steps that you go through there. So again, let's just make sure that we clear up any of the misconceptions and the myths that are out there about this product. So as a HECM borrower, you do not give up title to your home. The lender does not take ownership of the house any more than they do on a traditional loan. There's just no difference there in terms of the loan is the loan. You pay off the loan, it's your house, and it's the same way that it works. The lender does not take the appreciation either. So let's take a different example. Let's say that your house is $300,000 today. You take out this HECM mortgage, and suddenly the house becomes worth $1 million, and that's within the next 10 years. Well, the mortgage company has a loan on it, and that loan is going to be growing in value. However, all of the excess equity is yours, just like on a traditional loan. They don't come and take the equity from you there, and it's the same with this. Because you're not making payments, the reserve or the equity in the house is being used, but it's used at a set rate. It's not being used at a way that the appreciation is going to have any impact into that. You do not incur debt that is passed on to your heirs. Remember, it's a non-recourse loan, so there's no way that you can hurt folks with that. And what's interesting about this is that we talk to kids all the time, and it's not a concern for them in that situation. Typically, that's not. They want mom and dad to be taken care of, and so that's not a big issue many times. Again, you can never owe more than the value of your home at the time of repayment. Other assets, they'll never come and go into a bank account or anything to take away assets. Those are all myths, and all of those things may have happened in the past before this was as regulated as it was. There were some private companies that would pull some stunts like that. We're talking ways back. This has obviously become a much more regulated product, and they're concerned because the demographics prove out that the aging population is taking place, and that many seniors just don't have the funds that they thought were going to be there for retirement. So they want to make sure that there's some other ways that we can get into some of the assets that you have. FHA mortgage insurance will pay off any short sale or any shortfall from the sale. So that's taken care of that way. Again, you don't have to move or sell until you choose to do so, provided you comply with the terms. Remember the insurance and the taxes and the upkeep. You don't have to have good credit to qualify. We've talked about that. You do not have to be debt-free to qualify either. Again, the proceeds just have to be enough to satisfy the current lien that's on it. And you do not always utilize all your home equity with the HECM loan. There may be some left over, but again, the mindset that you want to have is thinking that that's not necessarily going to be there for you, and plan accordingly. If you go in it with that mindset, you're safer. You'll not experience any impact on Social Security or Medicare benefits, but again, check with your tax advisor on that to make sure that it's not going to impact your situation. Again, children are not typically against these. I have many people say, "Oh, I don't think my kids will like this." Well, I've been on the phone, and many times when I do the consultations, I'll ask the borrower, "Would you like to have your child or your financial planner or some other party on the phone so that you don't have to explain this to them, that I can explain to them, they can hear the same thing?" And that is something that I utilize a great deal. And so we have the conversation, and many times once they kind of hear all the ins and outs and the myths and the truths and all of that, then they're much more comfortable with the situation, and it helps them to make a better decision, that some of the things that they thought were there are not there. So that's helpful. And again, most are extremely supportive of the concept. They're not as expensive as people think. Very little, or most of the time, it's no out-of-pocket expense. Because the closing costs are financed. And again, you have to look at this and say, compared to what? If I'm not making a mortgage payment and I'm getting rid of that, then there's some value to that. There's some risk associated with the lender. So there are some fees that are charged, but at the same time, you've just got to weigh whether or not that's the right situation for you. After the closing, you'll receive a borrower information and servicing guide. This is something that most lenders will give to folks that just, again, specifics include information on the 3-day right of rescission to make sure you understand that, the servicing of your loan, the important phone numbers that go with that, the line of credit draws. This is something that the line of credit, if you took one, you'd want to make sure that if you needed money, that you take it out at closing. If not, you got to wait 60 days for that first disbursement, just because they're setting up the loan and getting it with the proper investor. So it just takes a little bit of time to get that set up. And if there's some repair set asides, you got to make sure that that's available as well. There can be a direct deposit feature as well that typically takes about 60 days to access, where it can be automatically deposited into your checking account if you just decided to take the 10-year payment or a modified or a term payment. Those can be automatically sent to the accounts. Important reminders and helpful suggestions about the property taxes and homeowners insurance policies. Again, you're responsible for those payments, and maybe if you were making mortgage payments, those were included in the escrow, but that's going to be a little different with this situation. A power of attorney, it's recommended that you select a trusted family member or advisor to be your power of attorney. And that's important if you ever become incapacitated. I think that's good form for anyone in that situation, for any medical or whatever, to have that in place and be ready. Okay, this is my little disclaimer that I just have to read. We are not endorsed, and I'm not endorsed by HUD, FHA. I'm not acting on the behalf of the government in this presentation, so just be aware of that. And here's my contact information. If there's any questions that you have, or if there's anything that I can help with in answering some of these questions, I'd be more than happy to help. So thank you all. I haven't seen any questions out there, but I appreciate the opportunity to talk about this product, and please contact me if there's any other questions. So thank you so much for today, and that's great. Thanks.